Welcome to Skytech-Lens. The autumn of 2025 marked a dramatic turning point for Canadians, as the country was suddenly thrust into an energy crisis that few had truly anticipated. The air was crisp, the leaves were turning, and yet beneath the surface anxiety was growing in households from coast to coast. As temperatures dropped, the crisis hit home in the most literal sense. Families across the nation found themselves huddled in living rooms, wrapped in blankets, anxiously watching thermostats and wondering how they would afford to keep warm through the coming winter. Heating bills soared to unprecedented levels. For many, like a retiree in Quebec City, the shock was immediate, a staggering $180 increase in just 1 month. For those on fixed incomes, the spike was more than an inconvenience. It was a threat to their well-being. At the same time, petrol prices in Toronto and Montreal surged by 18% overnight. Long lines formed at gas stations, and digital signs flashed numbers that seemed almost surreal. For many families, the cost of simply getting to work or school became a daily struggle, straining already tight household budgets. The roots of the crisis ran deep. It all began with a sudden and unexpected halt in U.S. oil exports to Canada, severing a partnership that had endured for decades. The pipelines that once symbolized cooperation now stood as stark reminders of how quickly fortunes could change. Canadians were left grappling with the harsh reality of their energy dependency. Plans for autumn road trips were cancelled, family visits postponed, and the simple freedom of mobility was suddenly in question. The crisis forced families to make difficult choices, prioritizing essentials and cutting back on anything deemed non-essential. Small businesses, too, felt the pinch. Delivery services, local shops, and tradespeople watched their fuel costs skyrocket, threatening their ability to operate and serve their communities. For many entrepreneurs, the crisis was not just about numbers on a balance sheet, it was about survival. The crisis exposed a vulnerability that had long been ignored. Canada, a nation rich in natural resources, found itself at the mercy of international supply chains and the decisions of foreign governments. The risks of relying so heavily on a single energy partner became painfully clear. The ripple effects were felt everywhere. Grocery prices crept upward as transportation costs soared. Shelves in hardware stores emptied of space heaters and insulation. Newsstands were filled with headlines about the crisis, fueling a sense of uncertainty and frustration. The once reliable flow of oil and gas was disrupted, leaving Canadians to face the consequences. Highways that were once busy became eerily quiet, and the sight of closed gas stations became a new normal in many communities. In Ottawa and Washington, political leaders scrambled to respond. Press conferences were held, promises were made, but for many Canadians, the crisis was a wake-up call, one that revealed the precarious nature of modern geopolitics and the fragility of the systems they had long taken for granted. Canadians were forced to confront their economic fragility and rethink their energy security. Families sat around kitchen tables recalculating budgets, while experts debated solutions on nightly news programs. The sense of uncertainty was palpable, but so too was a growing determination to adapt. The crisis underscored the urgent need for diversification and resilience in Canada's energy strategy. Across the country, conversations began about investing in renewables, building new infrastructure, and ensuring that Canada would never again be so vulnerable to the whims of a single partner. The energy crisis of 2025 was a harsh lesson, but it also sparked a new resolve to build a more secure and sustainable future. The U.S. decision to cut off Canada's oil was driven by the America First doctrine, a policy that emphasized prioritizing American interests above all else. This doctrine was a cornerstone of President Trump's administration, aiming to reduce dependency on foreign resources and bolster domestic industries. The move to halt oil imports from Canada was seen as a bold step in this direction, reflecting a broader strategy to reassert American economic dominance on the global stage. President Trump framed it as a strategic move, prioritizing lucrative deals with Europe and Japan. By redirecting oil exports to these regions, the administration sought to strengthen alliances and secure more favorable trade terms. This shift was not just about oil, it was about leveraging energy resources to gain geopolitical advantages and create new economic opportunities for American businesses. The halt was also retaliation for Canada's digital services tax on U.S. tech giants. This tax, aimed at ensuring that digital companies pay their fair share, was seen as a direct threat to major American corporations like Google, Amazon, and Facebook. The US government viewed it as an unfair targeting of its businesses, prompting a strong response to protect its economic interests. The US imposed tariffs on Canadian goods, escalating the trade dispute. These tariffs affected a wide range of products, from agricultural goods to manufactured items, creating significant economic strain on Canadian businesses. The border, once a symbol of friendly trade relations, became a flashpoint for protests and political tension. The energy crisis was a tool in a broader trade war, pressuring Canada to comply. Factories faced shutdowns and the economic impact rippled through various sectors, from energy to manufacturing. The US aimed to use this leverage to force Canada into renegotiating trade terms more favorable to American interests. The US prioritized new alliances over its historic relationship with Canada. Diplomatic efforts were redirected towards strengthening ties with Europe and Japan, seen as more lucrative and strategically beneficial partners. This shift marked a significant departure from the long-standing North American partnership. Decades of shared history were overshadowed by transactional politics. The once strong bond between the US and Canada, built on mutual respect and cooperation, was now strained by economic and political maneuvering. Treaties and agreements that had stood the test of time were now in jeopardy. For Washington, it was business. For Canada, an economic declaration of war. The aggressive tactics employed by the US were seen as a direct attack on Canada's sovereignty and economic stability. Protests erupted and the political climate grew increasingly hostile. The crisis highlighted the fragility of international alliances in the face of national interests. As countries prioritized their own economic and political goals, the global landscape became more fragmented. The situation underscored the challenges of maintaining strong international relationships in an era of increasing nationalism and protectionism. Washington's decision sent shockwaves through Ottawa, leaving the government reeling. Prime Minister Carney condemned the US action, vowing to protect Canadian interests. The government's response was seen as reactive, lacking a strategic plan. Opposition leaders criticized Carney for failing to foresee the crisis. Provincial leaders demanded retaliatory measures, adding to the political chaos. Carney's decision to roll back tariffs was viewed as capitulation by critics. The crisis exposed deep divisions and challenged Canada's political unity. The government's handling of the crisis was a test of leadership and resilience. The American tariffs and energy blockade rippled through Canadian society. Economists predicted a $12 billion GDP loss and a spike in unemployment. Businesses faced existential threats, with many at risk of closure. The crisis hit ordinary Canadians, from logistics firms to farmers. Grassroots campaigns urged consumers to support Canadian products. While patriotic consumerism offered hope, it couldn't offset the economic damage. The crisis underscored the need for a resilient and diversified economy. The US used its energy exports to reshape global energy flows. By leveraging its vast reserves and advanced infrastructure, the country positioned itself as a key player in the global energy market. This strategic move not only boosted its economy, but also allowed it to exert significant geopolitical influence. It signed lucrative deals with Europe and Japan, sidelining Canada. These agreements ensured a steady flow of energy to these regions, strengthening alliances and creating new economic dependencies. The US's ability to provide reliable energy supplies made it an indispensable partner for many countries. The US became a dominant global supplier, leveraging its resources for influence. Its energy exports became a tool for diplomacy, allowing it to reward allies and exert pressure on adversaries. This newfound power reshaped international relations and shifted the balance of power in the energy sector. Canada, heavily reliant on the US, faced isolation and a need for new markets. The sudden shift in the energy landscape left Canada scrambling to find alternative buyers for its oil and gas. This dependency highlighted the risks of relying too heavily on a single trading partner. The crisis highlighted Canada's over-reliance on a single customer. As the US redirected its energy exports to other regions, Canada found itself in a precarious position. The lack of diversification in its energy markets became a glaring vulnerability, prompting urgent calls for policy changes and infrastructure investments. Canada lacked the infrastructure to quickly pivot to overseas markets. The absence of sufficient export terminals and pipelines meant that it couldn't easily redirect its energy supplies to new customers. This infrastructural gap further exacerbated the economic challenges faced by the country. The integrated North American energy market was fractured. The once seamless flow of energy between the US and Canada was disrupted, leading to economic and political tensions. This fragmentation underscored the complexities of energy interdependence and the need for resilient and adaptable energy strategies. The US used its energy surplus to reward allies and punish adversaries. By controlling the flow of energy, it could influence global politics and secure its strategic interests. This approach not only strengthened its alliances, but also served as a deterrent to potential adversaries. Canada faced the harsh reality of a world where energy security was uncertain. The shifting dynamics of the global energy market exposed the vulnerabilities of countries dependent on a single source. For Canada, this was a wake-up call to diversify its energy portfolio and invest in sustainable and resilient energy solutions. Canada scrambled to diversify its energy exports amid the crisis. The Trans Mountain Pipeline became a key route to Asian markets. Talks with Asian buyers led to preliminary contracts for Canadian oil. New relationships offered hope, but couldn't replace the US market volume. Canada's infrastructure was ill-equipped for major overseas exports. Competing in a crowded global market posed significant challenges. A brief alliance with Mexico against US tariffs quickly fractured. Canada faced the full force of American economic pressure alone. The crisis strained Canada-US relations, eroding trust and goodwill. Canadians reassessed their alliance with the US, feeling economic vulnerability. In the US, the decision divided opinions, exposing political fault lines. Some praised the move, while others warned of potential blowback. Border states reliant on Canadian trade faced economic disruptions. Democrats blamed Republican policies for rising prices in key states. The crisis forced both nations to confront the costs of their strategies. Canada learned the perils of dependency. The US faced alliance risks. The chill between Ottawa and Washington was a new reality shaping North America's future. Thanks for watching. Subscribe the channel for more updates.